The RidgeWorth Mid-Cap Value Fund. It's been a top-performing fund in its universe for some time, ranking in the first percentile against its peers for the last 5 years and the top 8th percentile in the last year. Don Wordell has managed the fund since its inception. He joins us now from Orlando, Florida, to discuss his investment strategy and to give us some stock picks, of course, which everybody wants to know about. Don, thanks for joining us. Let's get to that criteria first of all. Obviously, when you're looking at mid-cap, you're looking at a certain parameter there, but what are some of your other filters when you're looking for investments?
Sure. The tenets of our philosophy are threefold. The stock has to have dividends, attractive valuation, and a compelling fundamental catalyst over the next 12 to 24 months to be included in the portfolio.
Okay, so that seems like pretty straightforward here. Let's get to some of your picks then and talk about how they meet these various criteria. The first of them, MB Financial. This is an interesting one because it's sort of benefited, if you will, in a way, from the failure of many banks over the past couple of years. It's been buying them up. So what's going to be the catalyst in this case going forward?
It's going to be the tremendous growth in pre-provision earnings power at this bank. I mean, they're getting their market share built in Chicago for free by doing the FDIC-assisted deals. The stock has a minimal dividend yield right now, but we think that's set to grow aggressively over the next, you look out over 2 or 3 years, and that dividend could grow with the earnings power grows. And look, the catalyst is going to be as they consolidate the Chicago market and build their pre-provision earnings. We think the stock has something north of $3 in earnings power. Stock's roughly $16 today. That's very attractive on a valuation basis as well. So we see tremendous upside.
I mean, is the company going to struggle, though, in terms of that earnings growth? I was looking at its history in terms of earnings versus what analysts were expecting. In 6 of the past 7 quarters, it's missed analyst estimates, in some cases by a pretty broad margin here. How is the company going to sort of get up to speed in that respect?
Right. Well, let's just talk about the last quarter. For example, they had when you get these FDIC-assisted deals, without spending time going through the complex accounting, it creates a gain because you're protected on the asset side of the balance sheet. This gain is then offset by bringing forward credit costs, and so it looks from a bottom line perspective that they missed the analyst estimates, and they did, quite frankly. But having said that, they've been able to reserve very aggressively, and we think that their credit credit provisioning is peaking, and so the operating leverage is going to be created as provisioning declines is going to drive that pre-provision earnings and bottom line for MBFI and grow their book value.
Let's get to your second pick here. Very different industry, obviously. Chemicals. Ashland is the company we're talking about here. And here, too, the dividend yield is not huge. We're talking a little over 1%, about 1.2%. But when you look at the catalyst here, the company's been doing some restructuring. Tell us about that.
Right. Ashland has a long history of culling the portfolio and, selling businesses that are low return, low margin businesses and investing in higher growth, higher return businesses. It's my belief that Valvoline, which is one of their core businesses right now, is the margins are sustainable. A lot of investors don't believe the margins are sustainable. I think they are at these levels. They're going to, in all probability, look to sell their distribution business, which is a very low margin, low return business, and then invest in their higher growth, higher margin specialty chemical businesses that are geared towards the water industry. Over time, we think Ashland has, probably close to $6 a share in earnings power. And when they generate that earnings stream, this company will, in my estimation, begin to grow the dividend then as well because, they've always been very good about returning capital to shareholders.
Don, I want to get in. We don't have much time left. I want to get in your third pick, Intersil, 4.5% dividend yield, so obviously a higher yield here. We're talking about something in the semiconductor industry, though. Are you worried about something cyclical like semiconductors right now, given the economic environment?
Well, of course, I'm always worried about cyclicality. However, a company like Intersil, I'm getting paid a 4.9% dividend yield, almost 2 times the 10-year Treasury. This company has very minimal debt, and again, the attractiveness of Intersil is around the business model transformation from being highly dependent upon PCs to being more dependent upon the industrial end markets, which are higher margin over time.
Don, unfortunately, we're out of time. Thanks. We got some good picks in there for folks. Don Wordell, thanks so much for joining us. Appreciate it.